So $2.28 is a very significant level that I'm currently paying attention to.
And software plus AI metastasize into essentially a weapon of mass manipulation that has been available to different kind of actors to manipulate the population. For
Starting off here, it says the striking feature of Thursday's sell-off was its breadth. There was no obvious catalyst.
Some sort of man-made concoction gets spread around through the spraying from planes, put in the water supply, etc. And everybody finds out later it was all a scam.
So, as always, giving you guys some of the realest information and research in the game. And you guys know that here in the CYPRX research team, we really pay attention to what banks and institutions put out in terms of their fundamentals. Not only that, but we also have institutional grade software in this community that we utilize that gives us an edge amongst the average retail investor. And so in today's video breakdown, I'm going to be reading thoroughly through this Amina Bank report that was written today, November 21st. Paying attention to the dates, I want to show you guys how they are talking about exactly the manipulative tactics that we were talking about over a week in advance on a November 16th report. That just talks about why the market sold off this week so aggressively, why the sell-off continued, and why, one crowd of people thinks one thing and the other crowd thinks the other. Getting into the nitty-gritty of the manipulation that exists and how we here at CYPRX, I really truly feel like we have been shadow banned because we show people the truth. We show people the reality. We push past the hype and the outrageous price predictions, and we actually give people the basis, the foundation that they need to actually prevail in these markets. And I'm going to show you guys that, how it all played out this week, going over this. Hopefully it gives you some clear insights, and then leaving you all with some forward-looking optimism to end the call. We'll also get into the spectrum on how a lot of the selling that we're seeing right now is due to emotions and has nothing to do with the underlying infrastructure. That'll be said at least one time during today's call and shown with, again, insights from a bank in this space. Nonetheless, I just am always trying to give you guys juice when I see that it's due, right? With that being said, let's get started. All right. So very lengthy call. If you guys want to stick around, if not, hop off, watch the recording, but it'll set us up not only for reality for the coming days ahead, but also to give us a forward looking perspective into the coming weeks. Starting off here, it says the striking feature of Thursday's sell-off was its breadth. There was no obvious catalyst, no surprise Fed announcement, no tariff shock, no earnings miss. Even Nvidia's blowout quarter couldn't sustain a bid. Traders on social media called it pure unexplained liquidation chaos. But the explanation exists. It's just not simple. So I started off with that. And the reason why is because in this community, we had all these insights. We knew exactly now reading this report from a bank that covers everything that we've touched on up to this point. We talked about this weeks, days in advance. So just to show you guys that, coming over here, first to the analysis, all right? A lot of people think that this stuff does not exist. Again, I'm not going to sit here and show the world how we built these softwares, because then everybody would be able to take the code, replicate it, and go and sell it and probably utilize it for nothing good. But myself, Scalper, and the team behind the institutional deltas and the software that we provide for you guys is real. And it's shown itself time and time again to be some of, if not the most accurate information in terms of technical analysis that retail traders have access to. Okay. So viewing this post, calling out price action at about $1.90 to look at accumulation areas on XRP, those levels were met. We're still seeing whether or not price can come down into deeper areas of interest. We'll go over that technical analysis aspect as well in today's call. I'll briefly touch on the updated order flow and volume charts just to kind of take a look at what market makers did at the deltas and the dark pools to kind of really show you all in real time how, when these catalysts fundamentally happen, it actually shows itself in sell pressure on digital assets like XRP, which proves my point that if these catalysts continue to escalate, it is not going to result in a bullish reaction. and it is most likely going to resolve in some type of very aggressive risk-off restructuring, which is going to negatively affect the price of a lot of assets if, again, it does unfold. Even coming from a major bank that is operating in the crypto space, Amina Bank, they say the same thing that we do here at CYPRX, and that it would create a very, very big cascading risk-off event. XRP, unfortunately, would fall victim to that event. All right. So, showing you guys the November 16th report, going back, what were we talking about? Just looking at the highlights via our risk-off scenario. We talked about the possibility of a hawkish leaning Fed. We got that. We talked about them mentioning inflation remaining stubborn. We got that. Labor market looking relatively resilient. We got that. Even though it showed some signs of cooling, it came out a lot more upbeat and resilient than most people were expecting. We talked about if the Fed mentioned that they see no urgency in cutting rates, the market will likely assume that there won't be a December rate cut, and that alone could trigger more sideways price action or worse, selling. Then right down here, we talked about Japan remaining a key global risk factor this week. While most traders are fixed on US labor data and Fed rate cut odds, we need to remember that Japan is also entering a heavy data week. We discussed and talked about that. Going back to what I specifically said here, because this is very important to understand this portion. As you see now in a bank report, it talks about the same exact scenario unfolding and putting pressure on risk assets. So I said we've covered this repeatedly. Mind you, again, this is our November 16th report. In previous reports, Japan remains one of the few major central banks still sitting near zero rates, and the yen's weakness against the dollar has been a growing concern. The yen continues to slide, especially toward the 155 to 156 per dollar zone. We could see forced interventions, and that would send shockwaves through the global markets. Now, this number has changed, and you'll actually see Amina Bank talk about these specific numbers. I believe they pushed it to like 152 or something like that, but you guys will see it here in a second. Yen interventions are rare, but when they happen, they often unleash sudden volatility and unwind carry trades and can trigger broad risk-off moves, especially in crypto, which reacts fastest to liquidity shocks. There's a podcast from the BIS floating around. I believe Anthony, one of our researchers, if not Osmar, but it was back in 2024 when the unwinding the yen carry trade happened in July, August last year. And it went on to mention these Bank of International Settlement representatives went on to talk about how if this happens again, it's going to happen at a much more granular scale. And it is going to, that crypto is going to be the first negatively affected asset class from this event.
Just more generally, since retail traders across all asset classes, they're offered very generous leverage by their margin brokers. They're very sensitive to the spikes in volatility and margin calls. And so they would be hit hard during such episodes. And also during the recent episodes, it looks like, for example, crypto was hit hard.
So the retail investors are having high leverage, so they're borrowing a lot to finance the trades, which makes them very, very badly impacted when things go awry.
Yes, they'll probably be the first in line. It looks like, for example, crypto was hit hard.
Awry.
Yes, they'll probably be the first in line.
Right. Which is why I've been so set on trying to tell people it's not going to be a cascading event that's net bullish for risk assets. Maybe long term, it has a bullish effect, but not in the immediate term. In the immediate short term, it's probably going to create a cascade of liquidation events that drop substantial amounts of over-leveraged positions from global risk assets like stocks and crypto, right? So anyways, we warned about this. Again, talked about all this at the beginning of the week. I'm just trying to show you guys to see what we were talking about. Now, why is this so important? We know that we live in an era of misinformation. And what's crazy is that there are video breakdowns on the internet from systemically important people. And I say that this is Joe Lubin, right? The co-founder of Ethereum. I say he's a pretty systemically important freaking person. He probably knows things that most people don't. And he can't just be on like his phone giving out freaking, disclosed information. Like dude's on NDA. He's an important person. He literally helped shape the future financial system by being the Ethereum co-founder, right? He's probably sat in with governments, central banks, for like you can only imagine, right? And listen to what this dude says. This is so crazy that just proves everything that we're trying to show and build for you guys here at CYPRX is that you should not be thinking like the average person. They use social media, and in my firm belief, these influencers, they pump out the algorithm. The algorithm is designed to cater to the misguided information, the hypey price predictions, the stuff that distracts the masses. He openly talks about how they have software that is specifically designed for this exact purpose. And he says this at the Future of Digital Assets Summit that took place just the other day. This was posted 7 days ago and only has 900 freaking views, right? So check this out. Just listen to what he says right here.
When software ate the world, it was good. And then software plus AI metastasized into essentially a weapon of mass manipulation that has been available to different kind of actors to manipulate the population to manipulate the population for political purposes, for geopolitical conflict purposes, and
So this dude at a freaking Citadel Securities conference just the other day literally just openly admitted that they have the technology to manipulate the masses. Think about it. You think they're not using it behind the scenes, these social media platforms to distract people? 110 freaking percent they are. And that is exactly why now is not the time to react emotionally and negative to the current price environment and instead know what is happening behind the scenes, which is why this community is so important to be a part of. Okay. Because I couldn't imagine being the type of person that is on the outside spectrum, thinking one thing and not seeing it reflected in your portfolio. That's manipulation. And that's exactly what's happening via all these influencers that have constantly touted to people these unrealistic, hypey things. And it's crazy that it's real. So as we continue to progress, this guy here, okay, this is the co-founder Chris Sylvian of Hyperion Dekimus. Hopefully, I'm pronouncing that correctly. And listen to what he says here about how COVID, mind you, again, this is from 4 hours ago, right? I'm probably gonna have to, when I re-edit this video, edit that word out, okay? Because you know that they don't like that word. But listen to this freaking dude admit, mind you, he's working with financial institutions. Listen to him say that they utilize COVID to freaking manipulate people. It was a scam. They dumped the market, bought the dip, and then pumped it all back up. Right? Listen to him openly admit this. This is wild.
And then from a pattern recognition standpoint, if you zero in on the structure, this looks a lot like 2019 and then looks a lot like March 2020. Let's examine the different backdrop. March 2020, essentially, everybody thought it's the end of the world, right? Oh, some sort of man-made concoction gets spread around through the spraying from planes, put in the water supply, etc. And everybody finds out later it was all a scam. I think that environment is a really good comparative because it was all about forced selling at that time and fear. In fact, we literally hit the same exact sentiment number from March 23rd, 2020 over the last, I believe, 12 hours. So I look at this as a phenomenal backdrop to accumulate.
So he just openly admitted that COVID-19 was a scare tactic to manipulate the masses while all the institutions were behind the scenes freaking buying. Then if you come over here and you listen to this dude, Matt Hugan, the CIO of Bitwise, from a day ago on the Milk Road podcast, listen to what he says. He says Harvard, talking about traditional finance, is buying, and retail traders are the ones right now getting liquidated and selling. Take a second and listen.
Right. So if you think about what's going on in the market right now, Harvard is buying and retail is selling, right? Abu Dhabi is buying and crypto natives are selling. And I think when we entered the year, the assumption was that the massive purchases from institutions and corporations would be more than enough to soak up any additional supply from retail selling. And I think the element to which I'm surprised with is that there's more retail selling than I anticipated.
Again, I'm just trying to paint a temporary risk-off backdrop in the minds for you guys to really understand that this could prolong itself if we see conditions worsen. But eventually, there will be light at the end of the tunnel. It's more so a matter of when, not if, right? So utilize, again, not financial advice. Let me rephrase that. I'm utilizing these opportunistic moments to build bigger positions on blue chip assets that I firmly believe will perform well in the long run, but understanding that the short-term pain that we could experience, the trials, the tribulations that are in the forefront ahead of us that we need to get through, could be very severe if they unravel. And a lot of people, again, because they are paying attention to speculative hype narratives, aren't understanding that number one, regulation is not aligned yet for these financial institutions to utilize crypto assets to solve liquidity unwinding conditions. That is a fact. You can go and read any World Bank document, any BIS document, any IMF document, and the proof will be in the pudding right there. And they're all available in this community, right? Number two, that heavily affected markets will be over leveraged risk positions. So when we read thoroughly through this, understand that. We'll take a look at the price action after this. This one's going to be very lengthy. So November 21st, 2025, markets react to Japan's bond yield rise and AI sector insights. What I really like about this breakdown is it goes over and discusses, because remember, we talked about in our risk on scenario this week, what we'd like to see is we'd like to see upbeat readings from NVIDIA. And we got that. That's what the headlines said, right? And you can see we even talked about this as a possible catalyst, as a possible catalyst up here in our risk on scenario. We talked about we wanted to see, where is it at? NVIDIA earnings come out upbeat right here. The NVIDIA earnings will tell us if the AI boom is still alive, which is critical for tech and risk assets like crypto this week, right? And when we read through this report, you're going to see the both sides of the spectrum, the side that was broadcasted to the retail spectrum, because when the report came out, everybody on Wednesday was like, oh my gosh, NVIDIA, bullish, right? But then they freaking dropped the futures markets. NASDAQ took a piss, freaking S&P 500 took a dump, crypto continued to sell. It was again another buy the rumor, sell the news event, because the underlying what's behind the scenes is net negative for risk assets for now, right? And this report really thoroughly breaks that down and does a really great job on showing fundamental insights as to the backdrop that we're currently living through and how it could escalate further and not be a good thing, probably leading to the even worst case scenario that we talked about, which is a much deeper correction down into those low, 2 trillion to high a 1 point some trillion dollar ranges. If it really did cascade into that type of event. Again, I'm not saying it is, but understand short term, it is going to be very, very painful considering what a lot of people were misguided to believe was going to happen if this scenario unfolded on the internet. Think about it. I showed you the manipulative tactics, right? That's why I started with this, because the masses are believing one thing, but in reality, what is being set in stone is a completely different reality than a lot of us were expecting. And it's going to F up a lot of people. So the number tells a story that no single headline can capture. Japan's 30-year government bond yield touched 3.38%, the highest level in history. Bitcoin has plunged below $86,000, down over 7% in 24 hours. The S&P 500 shed 1.56%, while the Nasdaq dropped 2.15%. NVIDIA, fresh off a blockbuster earnings report that beat every estimate, somehow managed to give back all its gains and more. What markets are pricing in today is not the single catalyst. It's the convergence of three structural forces that have been building for months. The death of Japan's zero rate regime, the unraveling of the yen carry trade, and deepening questions about whether the AI boom is built on phantom revenue. First, Japan breaks the global liquidity machine. The proximate cause sits in Tokyo. Again, this is from the 21st from a bank, and we talked about this catalyst, right? Something that would weigh on risk assets if it escalated back on November 16th, guys and gals, right? That shows you how serious and how much of a reality this is for risk assets that we invest in if it continues to escalate. The proximate cause sits in Tokyo. Japan's 30-year government bond yield rose to 3.38 on Thursday before easing to 3.32%. Still the highest level since the series began in 1999. The 10-year climbed to 1.80%. These aren't just numbers on a screen. They represent the end of a 35-year regime that has quietly underwritten global risk-taking. For decades, Japan's near zero interest rates made the yen one of the most world's preferred funding currencies. Investors borrowed yen cheaply, converted to dollars, and invested in higher yielding assets like US treasuries, equities, crypto, and emerging markets. Estimates of this carry trade range from 350 billion in transparent positions to as high as 20 trillion when including derivative exposure and synthetic structures. When Japan yields rise, the mathematics of this trade break down. Higher Japanese rates means higher borrowing costs. A stronger yen, which typically accompanies rate rises, erodes returns on foreign investments. And at some threshold, the trade flips from profitable to unprofitable, triggering systemic liquidations. We saw a preview of this back in July through August 2024. How many times in this community on these Zoom calls have we highlighted that when this happened last year, the crypto market shed over 700 billion freaking dollars in 1 week? Gone. In the blink of an eye from the markets. However, there was a very sharp V-shaped recovery afterwards, which is why I constantly say that when this happens, it is not going to result in immediate price bullish appreciation. It is most likely going to result in a liquidity shock that is going to liquidate so many over-leveraged positions that most people are not prepared for that type of price action, right? And this recent drop that we saw at the beginning of October was just a little glimpse of that, if it really does unfold and cascade into a deeper event, right? When the Bank of Japan raised its policy rate last year to 0.25%, the yen surged 12% in 3 weeks. The Nikkei 225 fell 12.4% in a single session, and the Nasdaq dropped 13%, peak to trough. That was a modest unwind of perhaps 500 billion. The total exposure of the unwind was of a larger magnitude. This is where it gets pretty crazy. Mind you, again, this says 500 billion. What's changed now is that Japan's fiscal positioning has become untenable. From Minister Sanai Takachi's government is preparing fiscal stimulus worth 17 to 21 trillion yen while simultaneously increasing defense spending toward the NATO 2% standard. Gross government debt stands at 230% of GDP. At current yield levels, debt service will exceed 10% of tax revenue by fiscal year 2027, a threshold historically associated with a fiscal crisis. Mind you, again, looking at these dates, okay? Let's get realistic with things. Let's not just make dates up on our own. Let's pay attention to the dates that they give us because these are the banks that are fine-tuned with all this information. So there's a key date to start to pay attention. The bond market is repricing this reality in real time. Life insurers and pension funds, traditionally the largest domestic buyers of Japanese government bonds, are demanding higher yields to compensate for inflation risks and fiscal uncertainty. The Bank of Japan holds 51% of all outstanding government bonds, cannot sell them without triggering a yield spike that would overwhelm government finances. This is what economists call fiscal dominance, a regime where monetary policy is subordinated to fiscal sustainability. Japan has entered it, and the implications ripple across every market globally. As this continues, the AI reckoning arrives early. Hold on, let me see, let me go back. Okay, sorry. So remember that this carry trade that unwound in July, I forgot to re-highlight this because I said this number is important. Okay, this is why I truly believe it'll be so much more worse for price action. Because if back in July and August 2024, $500 billion is what they're estimating was unwound. And that created a $700 billion negative effect in the crypto market in terms of price action from top to bottom during that week. And they're projecting that if this unwinds further, there are positions that could unwind from 350 billion to 20 fucking trillion dollars, you guys, of unwinds. Now, I'm not saying that that's going to happen, okay? But if anybody thinks that that's going to be positive for crypto, they are lying to you. If this happens, it is going to be painful, right? It is going to be painful. Now, hopefully we get the low end of the spectrum and they just unwind a $350 billion mere little blip, boom, whatever, brush off the shoulders, we're overreacting, we carry on. But if it supersedes $1 trillion and goes into the multiple trillions of dollars, nobody knows what that's going to look like. And what, oh my gosh, I couldn't even imagine. So I'm just mentally preparing you guys with a reality check to show you the size and the depth of how this could happen or what could happen eventually. The AI reckoning arrives. This is the great breakdown from Amina Bank on NVIDIA earnings, how the headlines presented one thing, but if you actually read thoroughly through the documents and read thoroughly through the data, you actually saw the underlying problems with the announcement. So against this macro backdrop, The AI trade is facing its own moment of reckoning. NVIDIA reported fiscal Q3 results that exceeded every estimate, 57.01 billion in revenue against 54, which was the expected, and earnings of $1.30 per share against $1.25 as expected. So that's clearly much better. And guidance of about $65 billion in Q4 sales versus Wall Street estimates of 61 billion. So let's see, just so you guys understand, in revenue, they exceeded. In earnings per share, they exceeded expectations. And in Q4 guidance and sales, they exceeded expectations. That's pretty damn good. Then, following that, CEO Jensen Huang dismissed the bubble concerns on the earnings call, noting that Blackwell, sales are off the charts. And cloud GPUs are all sold out. He pointed to a $500 billion pipeline of AI chip orders through 2026. Yet the following day, NVIDIA shares gave back their post-earning gains within hours and are now trading around $180 down from highs of above $212. What's happening? Well, beneath the headline numbers, forensic analysts reveal warning signs. NVIDIA's day sales were outstanding. A measure of how long it takes to collect payment has risen to 53 days, up from a 5-year average of 46 days. That gap represents $4.3 billion per quarter in receivables that aren't converting to cash on historical timelines. Inventory has accumulated by 32% quarter over quarter to 19.8 billion. And even as management claims demand exceeds supply, operating cash flow came in at 14.5 billion against 19.3 billion in net income, which is a 75% conversion ratio that trails industry peers significantly. These metrics raise questions about the nature of the demand. Third-party GPU compute prices on platforms like Vast AI have collapsed 40% since August, from $3.20 to $3.40 per hour, down to $1.90 and $2.12. If demand is truly exceeding supply, spot prices would rise, not fall. So they're pretty much saying in a nutshell that this dude pulled everybody's leg, you know, making it seem like this whole entire thing was net positive, and then the market makers and the forensic analysts saw the cracks beneath the surface and dumped on everybody, you guys. That's crazy manipulation. Because if you go and you read the headlines from Wednesday and Thursday, all of them, CoinGecko, freaking Watcher Guru on Twitter, all of them breaking NVIDIA earnings, beat estimates, bull runs back on, and wrong. Manipulative tactics to dump on the masses. And you can see the underlying fundamentals in the backdrop now, vice versa, from a bank's perspective, them kind of diving a little bit deeper into this. So I thought that this was really good. To continue, it says the deeper issue is the circular financing structure that underpins the AI boom. NVIDIA invests in AI startups like xAI. Those startups use the capital to lease NVIDIA chips or GPUs. NVIDIA books the leases as revenue and the cash flows in circles, with each entity valuation dependent on the other's commitments materializing. OpenAI, valued at 157 billion, generates $3.7 billion in annual revenue against 13 billion in operating expenses, and $9.3 billion cash burn. For that valuation to prove justified at standard venture capital return multiples, the company must eventually generate a cumulative profit exceeding $3.1 trillion. An MIT study found 95% of enterprise AI implementations fail to generate positive ROI within 2 years. So the question isn't whether the AI transformative or if AI is transformative technology, because it is. The question is whether the current infrastructure investment can generate returns before the funding structure collapses under its own weight. And that created uncertainty in the markets this week and led again to another triggering or cascading event that weighed on risk assets this week. So to wrap this up, it says these three forces, Japan's fiscal dominance, the carry trade unwind, and AI's funding question, connect through a single transmission mechanism, the global cost of capital. Since the early 1990s, abundant yen liquidity has suppressed neutral interest rates worldwide by 30 to 50 basis points. At Japan's zero rate, when that ends, this suppression dissipates. Conservative estimates place the structural increase in global neutral rates to 50 to 75 basis points. More aggressive models suggest 75 to 100. Every asset price globally is a discounted stream of future cash flows. When the discount rate rises 75 basis points, valuations compress proportionally, roughly 12 to 15% for equities, all else equal. This isn't a cyclical adjustment that central banks can offset. It's a permanent shift in the equilibrium cost of capital. For leverage strategies, the math is worse, right? And we know how much leverage right now is in crypto. The interest rate differential between the dollar and yen assets generates 5.3 to 5.7 annualized returns at current exchange rates. But if the yen strengthens beyond approximately 152 per dollar, currently at 157, carry returns compress below hedging costs. At that point, systematic liquidations begin. And again, remember how my numbers were completely off from the bank's numbers, but still nonetheless, you guys can see in this report, I was talking about these same numbers on what could start to trigger these forced interventions. So this just kind of goes to show that I'm spewing out information this is exactly what the freaking banks are talking about and paying attention to. They're looking at the same levels. They're paying attention because if these things start to happen, that's it. It's the freaking pot's going to get tipped over, right? Japanese investors hold $3.2 trillion in foreign securities. Life insurance companies and pensions funds have increased foreign bond allocations to 15 to 20% portfolios. Repatriation of even a fraction would drain liquidity from U.S. treasuries. Whoa. What? Do you see that sentence right there? Repatriation of even a fraction would drain liquidity from U.S. treasuries and European government bonds. A sustained carry unwind would force deleveraging across multiple asset classes simultaneously. That is including crypto. Okay? Regardless if the people on the internet want to admit it or not, that is including crypto. 110%. Undeniable. The shift in global liquidity conditions rippled through every risk asset simultaneously on November 20th, but not uniformly. Price action. So it goes on to talk about this. This is where I talked about the striking feature of Thursday's sell-off was the breadth. There was no obvious catalyst, this, and that. However, the explanation exists. Against this macro backdrop, crypto markets reflected the broader deleveraging, but with critical distinction that reveal underlying strength. This is where we're going to kind of flip out of the pessimistic perspective and then understand that long term, most likely, again, projects that are building, partnering with the largest institutions that actually have real world use case and value will likely be broadly adopted and will recover long term. Bitcoin slid sharply over the past week, tracking the equity sell off on the 20th of November, and it plunged, we know that, down to $83,000, drop of almost 10%. This triggered roughly $831 million in long liquidations. Crypto flows worsened as the U.S. spot Bitcoin ETF saw nearly $900 million of outflows in one session, and sentiment hit extremes with the Crypto Fear and Greed Index dropping to extreme fear. Across all coins, the carnage was even steeper. Solana plunged about 10% in a day, and XRP and BNB and ADA each dropped roughly 8 to 15%. So they're literally talking about how these cascading events, risk off, have net negative effects on crypto. And if these things continue, it's most likely going to dampen the sentiment even further. Now, this divergence between short-term speculators and long-term institutional accumulators suggests the sell-off was driven by forced liquidations and panic. What did the gentleman from Bitwise say? The same thing, and it's coming from two institutional perspectives. Rather than a fundamental deterioration, this is a net positive statement right here. This means short-term, pain. Long-term, we rise from the ashes. When sovereign entities and treasury companies increase exposure during drawdowns of this magnitude, it signals conviction and long-term value propositions that are independent of short-term price action. What comes next? Talks about the Bank of Japan's monetary policy meeting next month. Talks about what the markets are currently expecting. Then it talks about how the tail risks are severe, and if these things unwind further, be prepared for more volume and volatility to the downside. Okay. Says the largest unknown remains the true size and concentration of the yen carry trade exposure. Modern financial engineering obscures ultimate risk bearing. Structured products, offshore vehicles, and synthetic positions create connectivity visible only during stress. Perhaps most critically, let's see what else was a face potential removal. Okay. The bigger picture. Thursday's sell-off was not a single event. with a single catalyst. It was the sound of three tectonic plates grinding against each other simultaneously. Excuse me. Japan's fiscal reckoning, the carry trade's contraction, and the AI boom's collision with accounting reality. The financial press will attribute the moves to Fed pricing or technical liquidations. That misses the point. What Tokyo's bond market signaled this week is that liquidity regimes and markets have relied upon since 1990 are entering into a terminal phase. Japan may no longer be able to afford to be the world's lender of last resort. The December Bank of Japan meeting will provide the next data point. The January MSCI rebalancing could put some pressure on strategies, and Q4 earnings will test whether AI revenue is converting into cash, and each of these moments carries binary risk that current volatility pricing fully reflects. For now, the system remains metastable, stable, unless perturbed beyond specific thresholds. Yesterday showed us how close some of these thresholds actually are, right? So I'll wrap that up there. But this was just such a powerful read right here and just kind of goes to show the possible reality check that a lot of people could get in the near future, especially via the expectation versus reality narrative, right? What's being broadcasted and utilized to manipulate the masses to believe one thing when the other thing is happening under the hood. I'm a firm believer that that is happening 110% in this space. Nonetheless, for sophisticated investors, for mature people, we're looking at these downside moves as opportunities, at least I know I am, to accumulate blue chip assets that are most likely going to come out of this storm and perform relatively well. With that in mind, let's head over and just take a look real fast at the TA, okay? Because this just gives such a clear perspective. This is undeniable proof that when these catalysts materialize, we can see buyers in an attempt to defend, but then they get trapped by sellers. And we see this result in sell pressure and sell volume escalate in trading pairs like XRP USD, which just goes to show that if these things happen and escalate further, we're likely to see similar price action, if not worse, right? If we're seeing sellers take over now, and we're just hearing rumors of these events taking place, and this is the type of reflection that we're getting, well, when these things actually cascade into an event that creates a huge amount of uncertainty in the global markets, we're probably going to see the same or similar or even worse price action. So showing you guys price action starting on Monday. What you'll notice is that prior to Monday, during Sunday market rollover, you can see buyers made an attempt to become aggressive in this bullish push to break the institutional dark pool. Over to the left-hand side, you can see that institutions threw up a trap and sellers started to trap buyers. You can see that reflected in a bearish candlestick with bullish volume trapped inside of it. And that happened right at the institutional dark pool at 2.28, which we've given to you guys well in advance. Following that, you can see that aggressive sellers followed through in the next bearish candlestick. That rolls us into the next day. This is Tuesday's price action. Tuesday's price action, buyers made an attempt to push price action back up into the highs, but you can see clear as day that there's no aggressive follow through. And instead, all of these bullish candlesticks have bearish volume in them. Following that, at a high, you can see a support was thrown up where we likely have an aggressive buyer here. That was then followed through with aggressive selling. Sellers, here you can see trapped buyers broke the previous support, started to throw up resistance, and then we continued to see selling follow through with buyers trapped. Mind you, again, all of this is happening when these fundamentals are coming out. So if this is going to be a positive catalyst for assets like crypto, why then, when we see aggressive buyers, are they getting trapped and sellers are overpowering them? It's because, again, or sellers are overpowering buyers, which means that there's more sellers in the market actively right now than there are buyers. Very simplistic, okay? Following that, price pushes down into our first area of interest. That was the $2.06 institutional dark pool, highlighted by this yellow line. We can see buyers tried to make an aggressive attempt to push price higher. They failed, and sellers trapped them at a resistance. Buyers made one last attempt to try to push. They got trapped here. You can see this bearish candlestick with trapped buy volume. Following that, they most likely on the lower time frames made one last attempt to push higher. Sellers trapped them. You can see that by this huge sell wall. Following that, we see aggressive sellers, and the aggressive sellers push through the institutional dark pool. Following that, buyers tried to make an attempt to push back above the dark pool, but you can see, yet again, we have aggressive buying, but what is it trapped inside of? It's trapped inside of a bearish candle. This is clear seller aggression, passive sellers defending, becoming aggressive enough to trap the buyers and push it back down into lower prices. Following over into Thursday, Friday's price action, we see sellers trap buyers again. They then become aggressive, pushing price back down into the deltas, which leads us to where we're currently at now. Buyers have started to show their hand. They started to hold this as support, but we would need to see sellers started to get trapped at lows, buyers become aggressive enough to break back above previous resistances where sellers trapped buyers at highs, and then we would need to see buyers trap sellers at those areas of interest and become aggressive above them, pushing price back up into the highs and overpowering all previous areas where sellers were aggressive enough to trap buyers if we want to expect any higher prices or any substantiating recovery in this price action, which we have yet to see. So the first area of interest right now that I'm looking at on XRP to stage some form of significant recovery will be the area where we can see there was a huge buyer that came in here. They tried to make an attempt to break above the dark pool. We can see that huge buyer with this buy imbalance following through with this support. They tried to break above the dark pool. You can see, however, sellers got extremely aggressive, threw up a resistance right above the dark pool. Then they became super aggressive. You can see that here with this yellow imbalance right at the dark pool, and they pushed price action back down. Following that, you can see all these buyers trying to make an attempt to push price back up and sellers just constantly beating down on them, trapping them. Same thing again here. You can see buyers trying to become aggressive to push price up through the $2.28 delta. They failed. Resistance held. Buyers trapped them. Here's a huge buyer trapped in a bearish candlestick. And after that, that was all she wrote. So in order for us to start to expect or see any higher prices or substantiating recovery on XRP, I'm going to go outright and say that we need to break above the $2.28 range and turn all of this previous price action into support and start to see the inverse of what we saw, which is buyers become aggressive above this dark pool, sellers get trapped at lows, and then the following through and the buyer aggression that we see break into higher prices. And until we see that, I'm going to go outright and say that even if price started to recover into any of these previous lower highs, we're still susceptible to market manipulation and more downside price action. We need to see buyers become aggressive above where they were previously aggressive, but where they got trapped by sellers. Aggressive sellers then showed their hand and continued to suppress price beneath these levels up until this very moment in recording, right? So $2.28 is a very significant level that I'm currently paying attention to. If we go lower, you guys have those levels. I've told you guys $1.56. We've also seen some institutional deltas, I believe, now pop up at about $1.20, if I'm not mistaken. You guys can double check that in the chat. We can take a look at that real quick. $1.56. There's some deltas down here at $1.05, $1.11, all areas of interest to just set alerts and alarms to, because if we were to see this cascading event that we covered in today's video breakdown unfold, it would likely be a catalyst that would open the door for these deeper retracement levels. All right. Outside of that, though, I just wanted to bring this to everybody's attention. This was such a great read. Shout out to the CYPRX researchers for this one. Mind you, again, all this information you guys can find. I know it's a lot. Trust me. I go through it every single day. But it is readily available to you guys in the CYPRX research sections here. Just kind of have to scroll through it. Nonetheless, great article to read today, covering the current landscape and the severity of what we're currently living through. Hopefully, everything that I just said does not happen. We see a market turnaround and we see the complete inverse of the current environment unfold. Maybe we start to see data support the rate cut narrative. Maybe the end carry trade does not unwind. maybe we live in a rainbow scenario, right? Highly doubt it. So just prepare for the worst case scenario in case it does unfold. As always, blessings to you guys. That's all that I have for you guys. I know that it's late, so I'll let you guys get back to your lives. I just wanted to give you some more of my time as I know next week we're not going to get a lot of that. So, blessings to you guys. I'll see you guys in the next Zoom call. Talk to you all on probably Sunday or Monday.